Hello and thank you for tuning in. Today, we will be focusing on an introduction to options. This presentation is brought to you by the California Society of CPAs. My name is Darrell Young, and I'm a volunteer board member and the chair of the Financial Literacy Committee for the Peninsula Silicon Valley chapter of CalCPA. I operate a wealth management practice in the San Francisco Peninsula area. As you can see in today's agenda, we will be discussing the basics of options. We intend for this presentation to be interesting and informative. The data points contained herein are believed to be current. However, please remember that this presentation is intended to convey general information, which may or may not be applicable to your personal situation. Please do not interpret the information here as advice for your personal circumstances. You should consult with your personal advisor, or certainly feel free to give my office a call. You can also submit a question online through my firm's website, as you can see on the right-hand side. So let's get started. What exactly is an options contract? Well, as you can see, an options contract is exactly that. Between two parties, a buyer and a seller, where the buyer has the right, but not an obligation, to buy the underlying security, and the seller has the obligation to deliver the security to that buyer if exercised. Also remember that options, in this case equity options, trade in round lots, which means that they cover 100 shares per contract. So for example, if you were to buy, let's say, a call option on Apple stock, that would be covering 100 shares of Apple stock. Now, of course, other types of securities also have options, for example, bonds, futures, indexes, currencies, but for the purposes of this presentation, we are focusing on equity options. And by the way, some of you may have heard the terms employee stock options. Well, we're not talking about that in this particular presentation. Know that there are some differences. Typically, employee stock options are not marketable, and they may contain trading windows and other restrictions. Options are created, as you can see on the right-hand side, for example, listed options on a stock such as Apple. Generally, a short period of time after the public offering has occurred, and they are online viewable, such as quotes on basic websites such as Yahoo Finance. And we're going to take a look at a quote example later in the presentation. So again, talking about the classes of options, two types, calls and puts. Calls enable the buyer to call or to receive shares of the underlying security at a particular stated price for a particular stated period of time. The seller, of course, is taking the opposite position. Puts are the opposite. Puts allow the buyer to sell a particular security at a particular price for a particular period of time. And as you can see there on the right-hand side, a graphical representation of what the profit and loss might look like on a particular transaction. It, of course, depends on the market price of the security. What does this all mean? Well, if you were to buy a call, it means that you are considering buying the stock itself, so you would consider that to be a bullish maneuver. And you can see there that the opposite holds true then for selling a call, etc. As mentioned earlier, let's take a look at a sample options quote. Now here is just a very brief snapshot. You can see some of the terminology is very similar to what you may have seen before in stock quotes. We're looking at the SPY ticker symbol in this particular case. The calls happen to expire November 20th. In this particular example, you can see the bid and the ask, the last price at which the option traded. And again, remember that the quotes that you see here should be multiplied by 100 because you're talking about 100 shares. Down at the bottom left, you see again some of the definitions for the terminology. What could happen if you actually owned an options contract? So again, if you are the buyer of a call, the three options that you see on the right-hand side, you could exercise the call, meaning that you want the seller to deliver the security to you. If you happen to be, as they say, out of the money, you could just let the option expire, in which case you've lost the premium. Or you could close out the options contract, meaning that you don't necessarily want to take delivery of the stock itself, but you just want to settle out the monetary difference. Now, can you just trade options if you have a brokerage account? No, there's an additional process to get approval. As you can see, the boxes from left to right. If you wish to trade options, you would inform your advisor, inform the firm. The advisor would share with you the options disclosure booklet, characteristics of options. Assuming that you've read all of the required literature, returned the signed paperwork, presumably your account would be approved for options, and there may be different levels of approval. Think of it this way, conservative to aggressive, and your account might be approved for certain types of options or certain level of trading. Another question that may come up, is margin required in order to trade options? No. Margin, to put it simply, the ability to borrow money to trade more stocks. No, you don't necessarily have to have margin. You can trade options in a cash account. What are some common strategies? Well, of course, options sometimes are thought of as hedging instruments. Some other people may assume that options are aggressive. Not necessarily so. Options are just tools, and tools can be used in a conservative manner or in an aggressive manner. It depends upon the person using the tool. But let's just say, for example, in the box there you see at the top, if you happen to own a particular security, you're said to be long that position. So for example, let's say that I own some Apple stock and I have purchased a put option on my position. Well, that essentially affords me some insurance in the sense that if the Apple stock were to drop in price, the put option that I've purchased allows me to sell my Apple stock to somebody for a particular price at a particular time period. Now, there are more advanced strategies, as you see there, some of the fancy names, perhaps you've heard of these before, spreads, straddles, strangles. Just know that options, think of the calls and puts like Lego pieces, in the sense that these fancy names for other strategies are really just combinations of calls and puts. There's also the idea that you could trade options naked, in the sense that you don't actually own the underlying security. This would be considered to be a more aggressive type of a strategy. Now, of course, trying to cover options in 10 minutes is really hard to do the topic justice, and even more so if we're trying to talk about taxes at the same time. Just know that the effect is likely to produce a capital gain or loss to you. So for example, if you bought a call, well, that means that you've paid a premium, and if you simply allow the option to expire, then what have you lost? The premium, and you might consider that a capital loss. So again, you see the various scenarios there and the various components. Again, it could vary based upon whether or not you are the buyer or the seller of the position, but just know that there is a tax consequence, certainly. Unless you happen to be doing this in an IRA account, and IRA accounts also can allow options trading. So what's the role of your financial advisor? He or she could help you create an overall investment plan, which may or may not include options. And so, of course, the question becoming, would options be suitable for you? And this is something that you would hopefully work out with your advisor. Future topics for discussion. Of course, we talked about options as a potential hedging instrument. We didn't get into having a series of options transactions, which of course complicates the picture. But of course, we understand that, again, calls and puts, they're like Lego pieces, and you can stack them on top of each other, so to speak, to create various strategies. Margin accounts, we touched upon that. Shorting stock, which is another type of strategy altogether. And as I mentioned earlier, we are focusing on equity options today. Employee stock options, which are a kindred type of instrument, they are different though, and that would be covered in another presentation. Over to the right, before we conclude, I'd like to remind you all, of course, of what we believe to be the cornerstones for financial success. Planning in accordance with your goals and your risk factors, giving back to your community, working with people whom you respect and trust, and maintaining a positive attitude and a competitive awareness. We believe that if you are adhering to these attributes, that you have the makings for financial success. And of course, there are no shortcuts. With that said, I'd like to thank you for your time and attention today. I certainly hope that the material was interesting and informative. It's really hard to cover a topic like options in 10 minutes, but we did our best. Certainly welcome you to give my office a call if ever you have questions or concerns. Thank you very much.